Hello and welcome everyone. I'm Robert Baharian and this is Masters in Investing. They say life never stops teaching and we never stop learning. This show is my exploration with investors to both understand and unpack what is going on in markets right now and what this means for business and for investors. Please don't forget to subscribe and leave us an awesome review. Let's get into it. My guest today was Slava Platkov, portfolio manager for the $800 billion money manager that no one's ever heard of, Dimensional Fund Advisors. The reason I brought Slava back onto the podcast was because when we spoke during 2020, so much has changed since then. During our conversation, we talk about the value spring, bouncing and not breaking. We talk about the GameStop saga and how a systematic approach allows investors and also Dimensional to profit from such behavior in the market. We also talk about whether or not the classic bond stock combination is as powerful as it used to be. I really enjoy speaking with Slava. He has this uncanny way of being able to distill such complexity both in financial markets and investing into something so simple. I had so many more questions for Slava, but this is all I've got for now. I really hope you enjoy it. Slava Platkov, welcome back to Masters in Investing.
Yeah, thank you, Rob. Good to be here and good to be here in person.
Excellent. You've got your coffee.
Got my coffee.
Hopefully you're ready to go.
Ready to go.
Excellent. It's good to see you back good to see you in person. Last time we spoke, it was via Zoom, and in fact, it was back in October last year. I was listening to the podcast last night in preparation for today. And there's so many interesting things that I just want to go back to and maybe progress that conversation just in light of what's been happening since then. But there's a few things that have also evolved since then, which I just want to touch on as well, if that's okay with you. The ETF revolution has been going on for some time now. And if this is something you can't talk about, just let me know.
Sure.
But Dimensional resisted that for many, many years. And the pitch, certainly from an advisor's perspective, was that somewhat exclusivity of access to your strategies and so forth. And I know that there's a number of advisors, and in the US as well, that use that as a bit of a pitch or a marketing to their clients. Say, we've got access to a whole bunch of things that you ordinarily wouldn't be able to access. Now, I think you guys launched 3 or 4 ETFs over in the US, and I think that was for 4 weeks. You raised in excess of $1 billion in 4 weeks.
That's right, yeah.
Insane. And from what I understand also is that you're converting close to $30 billion of managed funds to ETFs as well.
Mutual funds, yeah.
Yeah, mutual funds to ETFs. Yeah. Can you just give us a bit of understanding or maybe some insight as to why you sort of gave in almost to that revolution and what that then means for the concept of access, especially a lot of advisors in the US who are pitching that for their clients?
Yeah, absolutely. We don't really think about it as like the distribution model and the fact that we work so closely with the advisor, the onboarding, the conferences and all that stuff. That was just mostly around making sure that there is an enormous amount of alignment in terms of how the advisor invests and the products that we provide for that advisor to invest their clients' money into. What we're also really cognizant about is just giving advisor access to our products in the best and the cheapest and the most scalable way possible. And that's what ETFs was all about. So it's not, we don't think just because we're launching ETFs now and all of a sudden anyone can go out and buy this stock. We don't think all of a sudden, those ETFs are going to be held 80, 90% by just people who are trying to pump value, for example.
Yes.
That's not what we expect. We still expect those same advisors that they don't need to be accredited now, sure, to buy the stock, but we still expect those same advisors, accredited advisors that we have been working with for a very long time, who understand not only now understand what our products have on offer, but also understand the pros and cons of investing in an ETF, which is something that we're going to start educating people on as well. So that it's still going to be, those ETFs we expect them to be very much held, to the vast extent held by advisors or on behalf of their clients who know exactly what dimensional do, who have been accredited, who have gone through that onboarding process.
And those advisors that are already investing with you and believe in your strategies, you are of the view that they're going to keep working with you to understand what is going on, again, for the benefit of their clients.
Exactly.
So that's not going to change.
Exactly. That's what it's all about. It's about giving our clients a different way to access our product. If they want to do it, it's great. That's what we're doing.
And one of the things that I know Dimensional have been extraordinarily good at is being able to, and this is a business perspective, right? Being able to maintain fund flow. So from any money manager, fund flow is important because that makes or breaks your business, right? And Dimensional have been able to maintain a really organic trajectory up. There's no big wild swings. With the ETFs that are coming on the market now, does Dimensional feel as though there may be, you sort of might ruin that nice uptrend with the ability for anyone and everyone just to jump in, jump out, and they're the investors that you don't want.
Yeah.
They're the clients that in my advisory firm we don't have because they're not in and out, right? And they're very long-term investors as well. So we don't want those clients either. Yeah. Is that a consideration that Dimensional have looked at?
Look, I'm sure, as you know, I'm sure people at the right levels are thinking about that.
Yeah.
But I think, again, the key is that our expectation at this point in time, from a business perspective, is that the vast majority of those ETFs are going to be invested by advisors that we work in very closely with.
Right.
The same advisors that are investing in our trusts or mutual funds in the US.
Yeah.
So it's all about just giving them that other avenue to access our portfolios.
Well, I look forward to those ETFs coming and becoming available in Australia.
Australia, it's a slightly different situation here. We are very keen and we are thinking very hard about launching ETFs here as well. In the US, it was, the investment case for tax effectiveness is enormous in ETFs.
Why is that?
Well, because the rebalancing. So you buy a stock, which is your ETF. Underneath that, there's a lot of there's these parcels that are being traded of stocks, which is how you rebalance your portfolio. The exchange of those parcels of stocks, whether it's accommodate a redemption or accommodate an application, new shares, it's not a tax event in the US. So you're actually it's a very tax effective strategy in here. In Australia, the rules are a little bit different. You don't get as much tax effectiveness in Australia as you do in the US. But still, that ease of access, it's still very important to our clients here. So we're exploring things for the Australian advisors as well.
Yeah. When we spoke last time, we were talking about systematic investing. We were talking about what to look at when you invest in value stocks. We talked about brand value. We were talking about intangibles at the time, and you gave... You gave me a really good example of Disney and Mickey Mouse, and that was awesome. We talked about a whole bunch of other things. Since then, you've raised over $1 billion in ETFs. But the other thing that has happened since you and I spoke, quote, you said, "Every day I'm trying to move to the ideal state based on most recent information."
Yep.
For example, a stock's gone up in price, all of a sudden it's less attractive to me. I should consider selling it and reinvesting into something that's cheaper.
Yep.
What's unfolded since you and I have spoken has been this rotation from growth-orientated stocks to value stocks.
Yeah.
And the question I asked you was, has that value spring compressed so much that it's going to break? You disagreed with that. You're of the view that the spring was just going to bounce back even quicker and stronger than ever. And it appears as though that's what's unfolded. You've got a big smile on your face now. You're pretty happy and pretty relaxed about things, I'd suspect. maybe just talk to us about what's happened since you and I spoke with the shift from the big growth tech names to almost this resurgence again in value stocks.
Yeah, look, it has been a nice 6 months. I think to start with, and I would have said this last time we spoke as well, Rob, is this premiums is not something that you can time consistently. When we spoke back in October, I would have said something like, look, if you ask me now where the value growth spreads are versus 10 years ago, if you ask me if the expected return is higher for value, I was confident and happy to tell you, yes, I think the expected return is higher for value 6 months ago, right, than it was 10 years ago. Did I know that we're going to have as strong of a rebound over the next 6 months as we've had? No, I could not have predicted that, and I would never have tried. But yeah, it is really nice. And we've seen that previously, particularly after periods where you do get that consistent divergence in performance, whether it's value outperforming or underperforming, you do get that really sharp bounce back, and that's what we've seen. We've seen, the last quarter of last year was incredibly strong. There were days in October where we've had, like if you look at the two corners of the market, large growth versus small value.
Yep.
The dispersion in those was sort of double-digit type return over one single day. And to your point around, what I do, the daily process that we carry out at Dimensional, my focus is to maintain focus of our portfolios on those characteristics. So if it's a portfolio that's trying to deliver the value asset class to the investor, I want to make sure that portfolio is exposed only to value securities every single day. The main thing about these bounce backs is, it's great that they're happening, but it's also, can you capture them in your portfolio? And that's really where I think Dimensionals, is superior to their peers, and that's really what we promise our investors, and that's what they're happy to receive. And so the last 6 months, obviously, has been, the performance of some of those more cyclical parts of the market, like the financials, the energy, parts of the market that have been beaten down for many, many years, they've bounced back strongly. And our portfolio's captured that.
And are you finding especially in your small value allocations, are you finding that you're now having to potentially, when I say trade more, don't take it literally, but relatively speaking to maybe this time last year, because you're relative to where we were last year, are you finding that you're having to now trade more because of a number of stocks that have really just skyrocketed since then?
Yeah, it's a good question you ask. The short answer is not really.
Okay.
Because what we've seen the entire cohort of small value stocks go up in price relative to the market, outperform the markets. Right. We already significantly overweight that cohort. When the entire cohort goes up, we don't need to do anything. That's the beauty of designing the portfolios the way we design it.
And why don't you have to do anything?
Well, because what we're holding essentially is a market cap based portfolio of small value securities, all securities with similar expected return. We're just holding them at a larger weight relative to their market weights, but equally, right? So when the whole cohort goes up, we've got to make sure that we continue maintain the overweight of the entire one. We don't actually need to do any trading. If a few of those names go up a lot more and they go into mid caps or they go into kind of the growth part of the market, that's when we've got to do the turnover. That's the beauty about splitting the market into these buckets or portfolios, if you like, of securities with similar expected returns and applying an overweight or an underweight versus what some of the other managers tend to do. They tend to be a lot more rigid and they do like a very scientific bottom-up optimization and they get an expected return number for every single security, and that ends up leading you to a situation where you've got to incur a lot more turnover to maintain that portfolio where you should be. Whereas if you split the market, understand that everything's really noisy, the metrics that we use, the premiums, the markets are very volatile, and make sure that those portfolios of stocks are diversified and maintain overweight, so you don't have to do a huge amount of trading.
So as that entire cohort rises, it's all relative, right? So your portfolio is rising with that, and unless individual stocks are going absolutely out of that realm,
which there always are, but as in the scheme of things, that's not a lot of turnover.
Yeah.
Yeah.
Do you think... So I've just got this chart here.
Yeah.
That's the growth to value ratio.
Yeah.
Do you think we've got quite a bit to go? Obviously, we've peaked out here at the back end of last year, and value is now outperforming growth stocks. And I'm going to ask you to do some forecasting here. This is not in your DNA, Slava. I'm fully aware of that.
Part of my remit.
But do you think, like, how much room do you think this has to run?
It looks, well, I mean, if you just draw an average line through that chart from, what is it, like 1975 there, it seems as though it may have room to go a little bit further. But like I said, it's very difficult to time these things. What's happened, and this is something I think I alluded to when we spoke 6 months ago, Rob, what's happened as well is because that growth part of the market is so concentrated in very few really, really large securities, it doesn't take much for the value premium to come in to jump out really strongly if that cohort of stocks just underperform a little bit, which is sort of what happened over the last quarter. Like, you didn't have...
That's right.
They didn't perform that badly. Like, I think the market return, global markets in Australian dollar, quarter 1, 2021 is like a return of about 6%, right? If I had a look at Facebook, I think actually Tesla performed better. I think Google, Alphabet performed better than the market. The other three performed a little bit worse, but not terrible. Like, it's not like minus 20% type returns we're seeing for Amazon and Microsoft. But because they're so large, and because they underperform by maybe 3, 4, 5% over a quarter, that just mathematically means that there's a strong value premium.
Yeah.
And that, if I had to forecast, that would be the reason behind why I would say it has got a little bit longer to go, because, like I said, that those stocks can underperform for us in a really small way for the value premium to be quite significant.
Yeah, Facebook outperforming, Alphabet outperforming. And then you've got they're the only two that out of Netflix and Amazon's that have been outperforming. So what you're saying is go long small value from here on in.
Well, hopefully it pays off. I mean, certainly like I said, our portfolios really do benefit, and it's great for our investors when sort of you've got the size and the value premium and the profitability. There's a lot more going on in the portfolio than just value.
Absolutely. Yeah, absolutely. Looking at this chart, technology beating industrials, and this is the number of days tech stocks have traded greater than 2% per day above industrials.
Okay.
Right.
Number of days.
Greater than 2% per day.
Wow.
The last time we saw this was back in 1999. That was the last time we saw that. And you can see nothing has happened since we had the tech wreck. And so to the comments that you're making, that really speaks to it, right?
It'd be interesting to see the other way around, like when industrials outperform tech for a number of consecutive days. It'd be interesting, the bottom half of that chart. But 2020 in global markets was the worst year for value. And 2018, 2019 were pretty poor as well. If you look at that really poor decade from like 2010 or even from the GFC to now and the value premium, it was pretty bad the first 7 years. But when you're standing in 2018, you're still going, all right, values underperform, portfolios probably underperform by 0.5%, 1% per annum. It's not too bad. The last 3 years leading into this pandemic were really, really tough. Yeah. Particularly, and obviously the pandemic started. That was the world's going towards working from home, and so everyone started to really pile into these large cap growth companies.
And interestingly, as reporting seasons in the US, even though a lot of these companies are reporting really well, they're getting hammered. Yeah. And obviously with Biden and CGT coming, capital gains tax changes coming in, it doesn't help. Can we talk a little bit about the cohorts that you talked about and these stocks going from small cap to mid cap? One of the things that my belief is that most people think dimensionals are very conservative, boring, if I can put it that way, money manager. And I beg to differ. There was a company, and this is only one example, there was a company that was making headlines all over the news, all over social media, and that company was GameStop. And without going into all detail about GameStop, I remember talking to a number of people making reference to GameStop, and that's not how you invest, and so on and so forth. To their surprise, through their Dimensional holdings, there was allocation to GameStop. And I think at one point in time, Dimensional was the sixth largest shareholder of GameStop.
Yeah.
Can you just explain to us how you ended up buying GameStop?
Yeah.
What happened, and when you exited, and why you exited? And I think that'd be really insightful for our listeners to hear that anecdote, but I think it's a real life example.
I think so as well, because it's it'll showcase a lot of the things that Dimensional. It'll showcase how we invest.
Sure.
Right. So GameStop listed, I want to say, in like 2002. We didn't start buying the security in our portfolio until 2010. We generally don't buy IPOs for about 12 months. There's some good reasons.
Why is that?
Well, there's really two main reasons. One is that there's some selection biases in terms of how investment banks allocate pre-IPO shares. There's some evidence that tend to favour their best clients. There's just not enough transparency for Dimensional to get the allocations that we're after. It's not a level playing field.
Sure.
Like the stocks that these investment banks think are going to do really well coming out of the IPO, they're going to try to favour their best clients with that, and vice versa. So you're not in that game. But the second reason as well is really important, in that what we see studying IPOs is that there's a lot of insider selling that takes place in the first sort of 6 to 12 months, which makes sense to us from an economic
after listing,
because if you list your business, Rob, and it's not like we're going to let you go. We still need you to manage the business, but at the same time, part of the reasons why you're IPO is because you want to get paid, right? You've built this amazing business, right? So there's clauses in place in your contract where you can slowly divest and realise some of that profit over sort of 6 to 12 months. So we want to make sure that pressure is out of the price. We want the price to settle down. We want those stocks to be widely held and trading with liquidity before we start investing. That's sort of around 12 months. So that's kind of.
And then, do you think that there's an element of lead managers, brokers, just pumping up the price on this thing?
Well, there's an aspect that they get allocated pre-IPO, and they for those IPOs that investment banks think the companies are higher quality companies, those managers get a better allocation to those ones. So it's not a fair. The first 12 months is basically not fair and not price transparent.
Sure.
As you know, price.
And you just let that flatten out and then start making decisions or start looking at things from there.
Correct.
So you were saying 2000, you didn't start buying GameStop until 2010.
2010, we started buying it because it's a small cap company. It was a small cap company. We've got our own eligibility criteria that we apply to our universe of securities that we can invest in at Dimensional. It popped up. It was large enough. It was liquid enough. It was widely held. The quality of financials were there. It was a good company for us to start buying. And the main, as you know, we've got a very large small cap business. Particularly out of our kind of head office in the US, and they're the portfolios that started buying this company. So our small cap portfolios, our core portfolios that tend to overweight small caps, that started buying GameStop. So you spoke about us being the sixth largest shareholder. We built up a very large shareholding in GameStop from about 2010 to about 2017. So around that period. From 2017, the characteristics of GameStop were it was small, it was still small, it was very expensive, so it was a growth company, and the profitability was pretty poor, right? If you put those characteristics together from what we know about expected return at Dimensional, that's a cohort of companies that we want to underweight and exclude from our portfolios. So from 2017 to 2019 to 2020 even, we have been slowly trimming our exposure to GameStop for those reasons, because the expected return was low, right? Obviously, that trimming takes time. It's gradual. It's very much cognizant of how much it costs trim. So every day, you know, if GameStop has those characteristics, we would send some orders to the market for them to slowly trim those positions in GameStop. So that's kind of where we were when this whole thing started in 2020.
And what was your allocation?
I can't remember. I think we still had like maybe 4% of the company, 4 to 5% of the company, something like that. Yeah. And the reason I'm saying it's such a good showcase of everything, of how Dimensional kind of approach these things, is because, again, very gradual. You know, we don't start piling into every single IPO. We wait for the company to be a proper company until we start investing, wait for it to meet all our internal eligibility criteria. We slowly build up a position because the characteristics are there. It's an exposure that we want to have in our portfolios. The characteristics change to something that we expect to have a lower expected return. So we slowly, with very much being cognizant of costs, start divesting. We get to 2021, which is when this whole thing started. You know, the stock goes bananas. You know, it goes from like $11 to you know, $300-400 per share. It's obviously no longer eligible for our small cap portfolios. It's too large, so we have to make a decision there. It is a momentum up security, which generally that means for us that we delay the decision to sell it.
Because it's going up?
Because generally it'll continue to go up. That's what the evidence says. So we have to take that into account. The characteristics, from a valuation standpoint, it's even more expensive. So we didn't like it already when it was a small cap high. It was a growth small cap company. We like it even worse now because it's now a mid cap growth company. So that was also, so there was an enormous amount of trade-offs that we had to make. But the most important thing that I wanted to communicate to you is that we run a systematic process, right? We manage, you know, 400 or 500 portfolios globally, and a lot of those portfolios would have some level of exposure to GameStop. We were able to get together as an you know, there's this amount of human oversight that we have in our process. So it's not automated. We're not like some of those quants that direct order straight to the market. There are, you know, we've got 150 people in portfolio management, some very experienced people. So we were able to get together at the end of January and say, okay, this is what's going on with GameStop. Bring it all to our investment committee. Have our CEO in there, all our senior portfolio managers, heads of portfolio management. This is what's going on. These are the characteristics of a company. These are the trade-offs. Let's make the right decision for all our portfolios collectively in the business. And that's when we decided to divest out of GameStop.
Completely?
Completely.
Divest or move from small cap to large cap? Did it move? Divest.
Yeah.
Because even though it moved from small cap and it may have become a mid or large cap, it still didn't meet the other characteristics, or was still low profit. It was lowly profitable, or whatever the other metrics were.
There was no portfolio that GameStop was a high expected return security.
Yeah, got it. So just because it fell in that universe, it didn't meet the criteria to...
Correct. Very importantly, what we got together and realised is that it was liquid enough for us to divest out of it. That was the real key, right? As you know, GameStop for that last week of January, it was trading with more liquidity than Apple.
Yeah, crazy.
Yeah. So it was actually an opportune time for us to get out of that position.
So you got out at the end of Jan?
In a very cost-effective way.
When was the date of your zero exposure to GameStop?
I can't recall. I think it was like a Thursday or a Friday of that last week of January. I think January.
You sold at the top.
Well, we sold. We didn't sell at the top. No, we sold.
29th of January.
It was in the 200s, somewhere in the price. I don't know. I can't tell exactly. Not that I can disclose this information anyway. But you know, it was a good decision. It was a good decision for the business.
So you would have made a shitload of money. I've just got a chart up here, man, and that's what it looks like to me.
Yeah. But look, you've got the chart going back all the way to 2003 or whatever. If you just zero in the last year or so.
Yes, even so. I mean, that's the end of January. That literal peak there, right?
Yeah. So we didn't sell at the top, but we sold. We got a good price. Yeah. But look, it's gone back up, right? So it's kind of what do you benchmark your trade to, right? It certainly made money for the portfolio. It was the wrong exposure to have in the portfolios. There was a few other decisions on the other side, like liquidity, momentum, that we needed to take into account. All that, we got together, put all those things on paper, made the decision to get out of it, got out of it,
Sure.
made money for the investors relative to the price that we built the position.
Sure.
Not relative to the price now, because that's not how we think, right?
Yeah.
So
Do you know what's really interesting is with investing, Dimensional would have bought GameStop for a variety of reasons.
Yeah.
But you selling out and its price, and whether you made money or not, it looks like you did, the fact that you made money was not the reason why you went in it from the beginning.
Oh,
and so that's the interesting thing with what's going on in markets at the moment. There's so much, and I want to get to this later on, there's so much speculation and so much bullishness in the market at the moment that the reason why you bought something is not the reason why you made money.
No. We bought something because it was the right exposure for the portfolio, or it had a high expected return.
Yeah.
We started trimming the position in 2017 because it got a low expected return, or divesting out.
And it was going down all the way down until 2020.
But the key is that there's this really valuable human oversight element, which came in super handy, when the pandemic hit this time last year, particularly in our fixed income portfolios. But it also comes very handy every so often when these type of situations come to the market, where you've got a stock doing something a bit out of the ordinary for obviously reasons that are not fundamental, and this ability to intervene with the systematic process, make a good decision for our investors, is really, really important, and that's a big feature of how we manage money at Dimension.
Can we talk about investor sentiment and how investors are allocating money at the moment? So if I look at this investor asset allocation, in the red line we've got stock allocation that is sitting close to 70% of investor money. This is US survey. In fact, it's probably the second highest since the late 90s back here at around 75%. Cash holdings and exposure to bonds are probably at the lowest that we've seen again since then as well. What's your take on investor allocation now? Obviously, with interest rates being at zero, people just don't want to hold cash, and yields on bonds are just really low at the moment. What's your take, Slava, on where people are investing their money and how bullish people are on stocks at the moment?
We continue to receive strong flows across all our strategies, bonds and stocks. Again, because of that relationship we have with our advisors, because we are a big advocate of the fact that stocks and bonds together is an incredibly powerful combination. Like, people do not give that combination enough respect, in my opinion. Bonds, obviously, at this point in time, the expected return is much lower than it was 5 years ago, 10 years ago, absolutely. But bonds will protect your capital. So, yes, you might not have that 30% of your portfolio in bonds because you're trying to eke out return out of it. But you want to still have it because equities are really expensive, because you've earned 12, 13% per annum for the last 12 years from equities.
Will they protect it when in January Q1, 30-year treasuries were down 20%?
Yeah, but equity markets gave you a 7% return in that one quarter.
Sure.
Right? So that is the powerful combination. 12 months ago when the pandemic hit, equity markets fell 37% here in Australia from top to bottom. Bonds gave you a flat return. Bonds are liquid. You can rebalance that and stick money in equities. 37% lower. That would have, as you know, with the returns we've had the last 12 months, that would have worked out really.
And did you see rebalancing in your portfolios back in March? I mean, that was again. I mean, we say once in a lifetime. They seem to happen more often now. But those opportunities, you see people actually taking action to rebalance their portfolios.
Absolutely.
And they're the ones that have made the money, right?
That was pleasing to see, but it was very difficult for us to implement.
Why?
Well, because bonds, particularly portfolios where your fixed income allocation has some exposure to credit, as you know, the credit spreads blew out quite quickly. There wasn't a lot of liquidity in those markets. So we had to, again, that human oversight was really important for that period, because our fixed income desk had to come together and really maneuver through what was a really, really challenging trading environment in fixed income. Obviously, particularly those couple of days before the government came in and really flooded the markets with liquidity. So, but what was really pleasing, Rob, again, to make this point, because it's an important one, is that the advisors that we work with, they were redeeming out of bonds and allocating money into equities, which is exactly what you should be doing. And they have reaped enormous rewards for their clients through the last sort of 9 to 12 months.
Yeah, absolutely. And if you look at fund flow, US equity ETFs and mutual funds, I mean, that's outflow.
Yeah.
And you've had one of the largest inflows in decades and decades. I mean, if you look at that sort of on a trend line, like you were talking about before, we probably sort of bypassed that, and we're back on track to where we were before. But I am pleased to hear that people are taking action and implementing a rebalancing strategy, because it is counterintuitive, and it does feel like at the worst time you're buying stocks, but that's precisely when you should be buying if you are talking about expected returns. And I think the big difference between good investors and great investors is that the great investors see beyond what is going on, and when the good investor sees is fearful and sees further losses, I think the great investors sort of smile with greed and see expected returns going even higher and higher. Because the more markets go down, the longer and further they go down, the probability of them going up it gets higher and higher. You just don't know when.
Yeah, absolutely. Yeah, that is a fact. The timing of how quickly it's going to bounce back and when, that's something is difficult to forecast. But you're absolutely right. But what it also, and you're not giving yourself enough kudos, Rob, what's also really important is good advice. And that's where good advisors are really, really important. I think overwhelmingly, I think people, particularly people that have built some wealth, they need advice to hold their hands through times like this. That discipline is super, super important. Strategic asset allocation, how, particularly if you were allocating through that period, continue to add to your investment. Imagine how you would be smiling right now, right, from ear to ear. Yeah, but that value of advice is really important.
Does Dimensional have any data around that, around investors working with advisors versus the investors that aren't working with advisors, and what returns look like for the two different cohorts? If you don't,
I don't know. I haven't seen anything. Obviously, anecdotally, we know that you always hear those crazy stories about people just making really bad decisions and destroying their wealth. And we know from working with our advisors around the amount of conversation they would have had with their clients throughout this pandemic to make sure that they remain on course, disciplined. Like we've had, I can't tell you how many meetings I did in the month of March and April from just advisors saying, what do we tell our clients now? What do we do with asset allocation? What do we think about currency? Like just this really, not even an investment question, it was more just practical. Like how do we go to our client and make sure that we can convince them to stay on course, because we truly believe that that's what we should be doing. So, so that's a really nice relationship. But again, the value of advice is very important.
Do you think there's a lot of stupid money just flying around at the moment, with a lot of money being made in Bitcoin? You probably saw the artist Beeple in March, the first 5,000 days NFT sold for $69 million. I don't know if you saw his response on Twitter when the piece was sold. Do you know what his response on Twitter was? Like the artist himself? He tweeted, "Holy fuck." That was it.
Yeah, he was obviously quite surprised himself, right? Yeah.
Like, people are buying this stuff, right? And there are millions and billions of dollars being made in cryptocurrency and that whole new realm at the moment. And I think it's way too early to tell as to whether or not these are genuine markets or not. But I guess my question is, do you feel as though there's stupid money just flowing around at the moment?
Do I personally feel?
Yeah.
Absolutely. Yeah. Do I think it's sustainable? Probably not. I mean, look at the property market in Sydney as well. It's kind of like, I don't know why all of a sudden 12 months later you feel like you can afford a property that's $2 million more expensive. Like, what's changed in your life to an extent where you feel confident enough to go and borrow that much more money and pay that much more money for a house? I'm not sure. That doesn't make sense to me, just personally. Nothing to do with that.
Sure.
But yeah, the cryptocurrency stuff, I mean, that's a roller coaster, right? I don't know too much about it, to be honest.
Do you invest in it yourself?
No. I'm not allowed to invest in anything. Not what I want to be honest. Cryptocurrency, it's very foreign to me.
Sure.
It's a currency that's quoted in the dollars of another currency, it's kind of, that whole thing is a bit weird.
Yeah, I was walking back home from the footy last night, and I just overheard a couple of three guys walking behind me talking about the property market.
Yeah.
And one of them said, "Oh, mate, just had my property revalued." And the other guy goes, how'd it come in? And he goes, "Oh, yeah, pretty good. Came in at 3.5. And he said, he goes, "I don't know what's changed that much," but he said, "Mate, would I pay 3.5 for my own property? Shit, no." And I just thought, anecdotally, these are professional valuers coming in, valuing these things, and it's as good as the last valuation. Really, that's all it is. And maybe there's a momentum factor in the residential property market as well. Possibly for a period of time, no different to stocks, but
it's market price, right? Demand, supply. The reasons they're so high because someone's willing to pay for them.
That's right.
Yeah, it's as simple as
right.
that.
And then you've got underbidders from the property before that couldn't buy; they were 100k short. They'll go and buy this one, and it appears as though the market's pretty strong at the moment. I don't know what's changed.
No different to the equity market. Like, it's just demand, supply, right? But it does seem very expensive.
Do you think this bull market can be killed? We've been running since 2009. I mean, yes, we had a 35% drop, and then we had I think it's since 1936 the greatest or the largest 1 year return at 76%. But that's obviously taking into account the fact that we fell 35% in, I think it was record time. But if you then just draw a line from 2009 to where we are today, it's just this uptrend. And the amount of government intervention that's going on now, is there a risk, Slava, do you think, again, this is probably not a dimensional perspective, but more Slava's perspective.
Yeah.
Do you think that there is a risk that investors no longer allow markets to just to play out, and you've got so much government intervention that is backstopping this?
I think there's what I expect, and this is Slava again, is for there to be more volatility, or when there is a piece of news that is adverse, I expect markets to react much quicker and in a much more of a meaningful way, like the corrections to be much more significant. That's what I expect. And that's because just behaviourally people have made so much money. If I can sell and at 20% less than what it was yesterday, it's okay because I've still made 300%. So you're just going to get this still demand supply, still market forces working, still that new information coming in the price very quickly. But I just think there's scope for those swings to be more violent, if you like.
It's almost gambling with the house money, right? You're so far ahead with casino money. Even if you lost a few hands and you pulled out, it doesn't matter because it's not your money.
Yeah, it's probably even more than house money because there's more liquidity. And like with the house, if, as much as that guy that you overheard the conversation, as much as he's sitting on this amazing amount of profit, it's still on paper. Like he has to move out and go live somewhere. That's right. So it's not as easy, right? But in equity markets more so. But in terms of just asset allocation, I mean, there's good reasons why. Where else would you invest money into now? Equities is still a very good proposition because if you think about the companies that you're getting exposure to, because ultimately they're the cash flows that you're getting exposure to, a lot of those companies are still doing pretty well. Yeah, they're priced more expensive than they were sort of on average over the last, say, 100 years, but you've got to think about other things that are going in the world, like where the interest rates are, for example. That's a big factor, just from a valuation standpoint. Also, just the motivations and how long you're investing for. So those things come into play as well. I think it's. I don't know if this bull market will continue, but yeah, I don't see any alarm bells.
So when you say they're more violent, do you also believe that they will be more frequent as well?
That I don't know. It just depends on the kind of the news flow that's coming in.
Yeah.
We've had a fair few. Like if you go back, think about sort of, like from the GFC, we've had a fair few violent swings. It doesn't seem like the obviously the coronavirus was the most violent of them all because you had a 40% fall in markets in 3 weeks. But we've had many, like we've had, the Greece stuff out of the GFC. We have the China stuff. We had Trump.
Yep.
We had a lot of big swings, a lot of days where markets was, going up and down.
Why do you think investors forget so quickly about that?
I don't think they do. The prices, what causes prices to change is just that marginal dollar. It's not all investors. Like, think about the price. If you buy one share of Apple at a price that is, much higher than where it's at now, the price is going to move towards the price that you're going to pay for that one share. Forget the other, 3 million shares that are outstanding. That one share is going to make an impact. So I think your average investor, or most investors, are not doing much at all, as they should be, right? They've got their strategy, they're exposed, and they want to maintain that. It's that marginal investor that are really swinging prices about, and I think that's why. And that marginal investor is the one who's going to say, "Oh, well, I don't care if I'll sell it at 30% less than what it was yesterday because I've made 300." They're the people making those decisions. They're the people that are going to move those prices.
And so, with more and more of those types of investors now participating in the market, what role do you think active management has in people's portfolios today? Because certainly, people trading GameStop and whatnot. Like, do you think that their position would be, why would I give my money to an active manager when I can go and buy and sell the stocks myself and I'm making money off it anyway?
Yeah, look, I think active management there's a place for active management.
What do you think that place is?
They're very smart, very educated, investors, and they have an opinion. The opinion, they think that these companies are worth something different to the market price. And they go out there and do a lot of work to make sure that opinion is well supported, and they go and act on that opinion through buying or selling. I think that's fine. On average, that cohort of investors has underperformed the index on average, but there has been some that have done well. We're an active investor, right? We're just systematic in the way we do it.
Sure.
And we don't approach markets thinking that the price is wrong. We approach thinking that let's use that to position our portfolios towards the characteristics that we're after. That's worked well. The other thing with active investors is that subjectivity which a lot of people are really attracted to, and that's fine. Like, if you really have belief in that person, like, it's no different to investing in a particular share because you believe the CEO is a very capable person who's going to do really, really good things with that company. So people have that same mentality investing in an active manager. That's fine.
Yeah. One of the things we talked a little bit about before was what happened to bonds at the beginning of the year, what stocks did, etc. With what's going on in interest rates, or what kind of did happen, it's sort of flattened out a little bit now. What impact do you think that's having on stocks and cash flow, discounted cash flows, people's nervousness generally around rising of interest rates and things like that? What impact has interest rates had on stocks, and what impact do you think it'll continue to have?
Yeah, I think, and that's the way we approach kind of stocks and expected returns. We think about that valuation equation, right? So you can have a high expected return security because you think the cash flows are going to be stronger than what the market currently is pricing in, or because you think the expected returns are going to be, the discount rate's going to be higher. Right, so with the bond rates being where they are now, and they've gone up a lot, right? The last 6 months, it's been a huge rise in bonds, but they're still at levels that are lower than they were pre-COVID. That's the thing that people don't. Everyone's very, we go on vaccination, we go on this back to kind of normal, this whole theory around that, and then that's really this inflation that's coming in as a result of that. Yeah. That's why the bond yields have gone up so rare, and it's been a rapid rise in bond yields for sure, but to levels that were still lower than they were pre-COVID. And if you remember pre-COVID, we had 5-6 years of economy doing really well, and the US was close to full employment. Trump, the equity market's going, everyone's making money. And yet the world could not find inflation. Yeah. Right? They would, because technology is very deflationary and it's very tough. So, yeah, I don't know. These concerns around inflation, personally, for me, they're not really, I'm not that concerned. I think they've tried. They were trying really hard pre-COVID. They couldn't find it. I don't see how it's going to change now. Obviously, inflation has gone so much during COVID that it's going to bounce back. Sure. We're going to see some big numbers in the medium term, but longer term, I don't think those bond yields are going to go. Yeah, I think context and perspective is really important. Yeah. What needs to happen for inflation to continue? Is it wage growth
that needs to remain consistent for inflation to have some support levels?
Yeah, look, you can really, we don't, that's what active managers do, right? They are in a position where they can really dig underneath that inflation print and what's underlying it.
Yeah.
And it's things like how much do you pay for petrol, so like oil prices, your rent is a big part of your inflation number, for example. Your grocery basket, the price of that is a really big part of your inflation number. What you pay for your utilities is a big price of that. And I don't really see those things going up too much. Obviously oil prices are much higher now. Rents are a bit, are nowhere near as high as they were.
Yeah.
So there's so many things that are playing there, but it's gone very low and now it's bounced back, and the world's a little bit concerned that vaccines and the world's coming back to normal. Everyone's going out there and travel again and spend money, but I think they forget very quickly that we've had good 5-7 years of that pre-COVID, and we didn't have inflation. So I'm not sure how it's going to be different going forward.
Yeah, time will tell on that one.
Yeah.
We talked about bonds before, and you said bonds aren't getting as much credit relative to stocks. When you look at different types of portfolios, and we've crunched a lot of numbers from 50-50 portfolios, 60-40, 70-30, all the way up to 100-0 portfolios. Yeah. And when you look at some of the returns on these portfolios long run, I'm talking 10, 15, 20 years, the average long-term return is very similar to that of a 50-50 portfolio, to that of a 100-0 portfolio. And I think part of the reason has to do with the fact that bonds have been on a pretty big bull run over the last 20, 30 years. Yeah. And so, when we talk to investors, they're like, well, why would I invest in a 100-0 when I can invest in a 50-50, less risk, but I can get as much return? Yeah. What do you think, what's your take on that now, based on where interest rates are at 1.5% now going forward, and that mix between bonds and stocks? Yeah,
no, I definitely appreciate your conundrum, because it's one of the most difficult things to, I think, articulate with advisors that we work and their investors, is that whole situation of bond returns have been very similar to stock returns.
That's right.
Like if you look at bond returns over the last 20 years, you're getting sort of 6%.
Correct.
With next to no volatility, so it's been like an information ratio of 2. Incredible investment. If you had the foresight and you can leverage that up, you'll be... What's
an information ratio, just maybe for the benefit of...
it's just the level of the risk that you basically risk divided by volatility.
Right.
So it's
a good number or a bad number?
It's an amazing number.
Right.
If as an active equity manager, if you can get to somewhere close to 0.4, you're doing a very good job.
Right. So 2's insane.
2's insane.
Right.
Yeah. So if you had the foresight, you would have been a very wealthy person. That's why they're looking at the 50-50 portfolio, and it's a very similar number to like a 100-0 portfolio, but it's all about what happens going forward.
Yeah.
Right. And as we just spoke, the combination of equity and bonds is really powerful. Right. Expected return from bonds are obviously much lower going forward. So, but you will get that protection, right? So if you are somewhat risk averse, like if you're close to your retirement, if you do need that income, you don't want to jeopardize your lifestyle. You should still follow those kind of those rules and go to a 50-50 or a 30-70 portfolio, because bonds will, and it's also, but your bond allocation is also important. Remember, when you get to a portfolio where majority of your portfolio is in fixed income or some defensive asset, the makeup of that defensive asset becomes a lot more important.
What do you mean by that?
So, for example, if you're in a 70-30, 70 equity, 30 bonds, the bond piece, you may as well go out and get the return in that bond fee as much as you can. Don't worry about the volatility of that bond piece, because the volatility will be dictated by the 70% that you've got in equity.
So are you saying just go all out guns blazing on the 30% allocation and just risk that allocation up?
Correct. So set up that portfolio to earn as much credit and as much term premium as possible. It's going to be more volatile than your average bond portfolio, but that's okay, because the volatility of that is going to be meaningless compared to the 70%, compared to the volatility you're going to get from equities. As you move down that spectrum towards a 50-50 or a 30-70, where all of a sudden bonds are now 50-70% in the return, you need to think a lot about the volatility of that bond piece. You need to control, do what you need to do to make sure that you're bringing that exposure to credit, bringing that exposure to longer term bonds, to interest rate risk. and make sure that exposure is in line with your overall objective.
So what you're saying is, as you move up the risk spectrum, naturally your allocation to bonds will get smaller.
Correct.
And what you're saying is, with that smaller allocation, go higher on the risk curve. Correct. In bonds.
Within bonds.
But more conservative your portfolio is, you need to think about a conservative allocation within bonds.
Correct.
And potentially also some smaller allocations to higher risky or riskier bonds within the bond portfolio.
Exactly right. So if you look at how we've got balanced funds that we manage, if you look at like a 30-70, 30 equity, 70 bond versus 70-30, the 70-30, the bond piece there is in our highest octane portfolio, our global bond trust. Big exposure to long-term bonds and credit. The 30-70, it's much shorter in duration.
Yeah.
It's much smaller credit exposure. So for that reason.
Yeah.
You use the growth part of your portfolio is the growth part. That's the engine. You need to use bonds to make sure that the volatility of the overall portfolio is in line with your risk profile.
That's a really interesting topic, because I think a lot of investors feel as though, I've got cash is not working for me, so we've got to go to stocks. And they've just jumped this huge river of opportunity where you don't have to take that risk. You can invest in almost this bond ladder, if you like, from really low, conservative, low returning, but very stable, to high returning, high volatile securities. There is that universe there. But I think from what you're talking about, and certainly what we've seen, most people just want to jump from cash to stocks. And potentially that's what's happening. That's why we're seeing cash allocation so low and stock allocation so high.
And it's crazy that they want to do that, given that the bond had given you 6% return over the last 20 years. Why wouldn't you want to capture some of that, right? In a very low.
Well, going forward, it may be unlikely that you're going to get the 6% per annum.
But there's still a spectrum between that, right? It might not be 6, it could be 3, could be 2, but in a way that protects your capital, in a way that's in line with your risk profile.
Yeah, 100%.
That's a really important thing to maintain exposure to.
How much value do, maybe not Dimensional, but Slava personally puts on the Robert Shiller's cyclically price adjusted earnings ratio, so the CAPE ratio? Yep. How much value do you place on that? Do you ignore it?
We don't ignore anything. Our kind of view on value is that it's the price, right? That's the real hero. So anything, a low relative price security is going to have a high expected return. What you divide price by, or how you structure that metric, which is the CAPE metric, is a secondary. It's more of an implementation consideration for us, right? So if you look historically, if you look at the research, price to earnings, price to cash, price to sales, CAPE, any of these metrics, they've all delivered you the value premium. If you form portfolios of cheap securities on those metrics, that portfolio would have outperformed.
But it's not only just over the next 12 months. In fact, the reliability of that's really low. You've got to start pushing 5, 7, 10 years. Correct. That's when
But because it's volatile, right? Equity markets are volatile. You've earned a return. So US markets go back to 1928. That's close to 100 years now. And the return that those markets have generated for investors is about 9% per annum, which is really strong, right? But the volatility around that is huge as well. You can still... there is a 17% chance you will earn a negative equity premium over a 10-year period.
17%.
So it's not. The odds are very much in your favour.
Less than 1 in 5.
83%. But it's still 17%. It's still meaningful, right?
Sure.
So you can go for a 10-year period with equity markets giving you a negative return or return less than cash, right? So it's possible. Equity markets are very volatile. You need that time, and the premiums. It's the same for the premiums as well.
CAPE ratio is sitting at around 33.6, the second highest since 1965, and the only time we saw it at this point was during the tech wreck. So we're close to almost 2 standard deviations above.
Well, it's the same as those spreads that you were looking at, right? It's the same. It's exactly the same thing. We are in value versus growth. We're in a place now where things are looking quite even with the last rebound. It's still looking very stretchy. I mean, we're nowhere near out of the woods.
Yeah.
If you look at our 10-year numbers, we're still underperforming in many of our portfolios by a small amount, but unfortunately we are. Yeah.
Do you know, we're from 2009 to 2020, we are on track to literally mirror the GFC bottom.
Oh yeah.
The red line is the GFC bottom to, I think, 2 years following the GFC bottom. That's COVID bottom to where we are today.
You love your charts, Rob.
Love the charts, Slava. So I want to ask you your opinion before we wrap up. That's the first one. And second one is probably too early to tell, but the blue line is the COVID-19 recovery. Yeah. The red line is the Spanish flu in the roaring 20s, and we've got the Asian flu just for perspective on that green line. Are we entering, Slava, a roaring 20s of the 20th century? Yes or no?
You keep asking me to forecast things. You know, that's not.
I know it's not your DNA, but take the cape off, and what do you reckon?
I don't know, Rob. It's honestly, it's not about the cape. I just haven't spent any time thinking about what's going to happen, too far in the future. We are very busy. We just want to make sure that in these times where there is turbulence and there are many decisions that our clients have to make, that we're there for them, and that's just not picking up the phone and talking to them about what they should do. Or it's also giving them the service that they're after. So making sure they've got all the information they have when they go to their clients, and they're in a really, really strong position to do that.
Maybe they need to look at some of these charts.
But what there is an enormous, and you probably know this better than I do, there's so many cases where you can demonstrate that staying disciplined, staying on course, being really diligent, and again, looking beyond what's just happening today has been a really important decision to make.
100%, absolutely. And I'm showing you these things. One, I'm really curious about what you think, but also I think it's really important for long-term investors to understand and see over long periods of time. If you do ignore the noise, you are rewarded over long periods of time. And it may not be, a 500% return like we had in the roaring 20s, but history says that if you're holding securities and risky assets for a 10-plus year period, the odds are pretty damn high for you to make money on that. What that return is, no one knows.
No one knows. Yeah,
but the probability of you making money on that is very, very high.
It's
very, very high.
Yeah, I agree.
I'm asking you these things because when we spoke last time, I asked you, Slava, that we're sitting here in 2023. I said, what is the biggest regret investors will have? Do you know what your response was? Do you remember?
What was it?
You said not doubling down on value. So you're one from one. You're 100% on the forecasts. So I'm going to ask you this one last time before we wrap up. We're sitting here in 2024. We're again 3 years ahead. What is investors' biggest regret right now?
Not maintaining their allocation to fixed income.
I like it. Slava, this is awesome, man. I really enjoyed talking to you. Thanks again for joining me today.
No, I appreciate that. Thank you very much for having me.
Pleasure.
Let's do this again.
100%.
Yeah. Thanks, Rob.